Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have John Rubino with me once again, one of my favorite people. I must say, John has actually hosted this show a couple of times, and I hope I can get him to do it again sometime in the future because he's really good at it. John Rubino, of course, I don't know if we should spend time going over his bio again because he's been with us so often, but you should check out dollarcollapse.com, where you can pick up on John's work and so many other good articles that are there. Just to give you an idea, best of the web, here are some of the articles that I just looked at before I came on the show. Why economic collapse will precede climate collapse. Well, we'll tell AOC about that, huh? $150 billion global corporate bond binge. That's another article. It's the pace and change that kills you, from peak prosperity. Fake MAGA, fake markets, gold seek. I mean, it goes on and on. They're just great, just endless numbers of great articles. And then there's a section on the economy, articles, deficits surpass $1 trillion, the CBO and the Hill. Mish Shedlack, who's been a guest on this show, has an article there. Phantom FDI, companies aren't investing, they're hiding money, so on and so forth. There's just so many good things. Precious metals section there, inflation, deflation, currency wars, cryptocurrencies, lots of good stuff. John, thanks so much for joining us again.
Hey, Jay, good to talk to you.
Good to talk to you, and you're talking to us, I think, from Washington or someplace like that, not D.C., for goodness sakes, thank God for that, but up in the Northwest, right?
No, I'm talking to you from an RV in almost the most northern part of Washington State. Yeah, so it's very pretty here, but there's some technical issues that I worry about when doing interviews like this.
Well, it's coming in loud and clear. You're very close to where I was last weekend in Vancouver then. You're not that far away from BC, just across some water there, right? So
that's one of the big selling points of this part of the country is you can get up to Vancouver very easily. That's my favorite city in the world, I think.
Well, it is lovely. We were just there for the Metals Investor Forum, found a lot of good ideas that I hope to be writing about in my newsletter in the near future, along with some of them that you know about. Some of them I know you've invested in that have done very well. But I want to get onto this topic, one that you just wrote about. You just wrote an article that's just been posted at dollarcollapse.com. The global debt bubble enters its blow-off stage. Really. Now, we were just talking to Michael Oliver, and Michael said some things that kind of, maybe he agrees with what you're just saying. On the other hand, Alan Greenspan just recently said that he thinks it's inevitable. It's just a matter of time before the U.S. currency enters into negative rate territory. But talk to us a little bit about your article, the one that's posted there. Why do you think we're at a blow-off phase? Because that would suggest that we may be seeing the end of lower rates.
Well, your listeners know we've been in a debt bubble for quite a while. And it's been years now that people have been pointing it out and saying it's unsustainable, yada, yada, yada. But lately, very lately, the bubble has entered a new phase that looks an awful lot like a typical terminal blow-off stage of a bubble. Let me just give you some stats, just a few stats.
Sure.
But China, through July, increased its total debt by $2 trillion, which is a ton of money for anybody. For the U.S., that's a really aggressive debt binge. But for China, which is a smaller, less well-developed country, $2 trillion in a little over half a year is an immense amount of money. And get this, just recently, after all that borrowing, the Chinese government cut bank reserve requirements, which is a way of increasing borrowing and lending going forward. In other words, so they're trying to turbocharge a process that's already at epic levels.
Yeah.
Now, in Japan, something very different is happening, but it's kind of symptomatic of the same thing. The junk bond market in Japan is being starved by banks that are so desperate for yield that they're lending money, huge amounts of money, to companies that 5 years ago they wouldn't have even looked at because they were too risky. But now you've got the banks basically usurping the junk bond market. Yeah. And one last thing, in a recent week, the global debt market had its biggest issuance on record. Even just U.S. companies raised $72 billion on 42 deals. And that again is a record amount of money, and it's a huge amount of money. So we're 10 years into an expansion, which is normally the point of the cycle when everybody's paying off debt, because they've been growing for such a long time and cash flow is rising and they've got extra money. They don't know what to do with it. So they use it to deleverage. This time around, we are leveraging more aggressively than ever in human history. 10 years into an expansion. So this has the feel then of a blow off top in a bubble. When you get people just giving up on any pretense of self-control and grabbing one last easy money deal. That's usually the kind of thing you see just before a bubble bursts. So, I know there have been a lot of predictions about the bond bubble bursting in the last few years, and it hasn't happened yet. But we're starting to behave in new ways, even more egregious ways than in the past few years. So it's very possible that this is either the blow off top or something very close to it.
But John, at the same time, central banks are certainly not tightening. They're loosening, as you just pointed out. They're being accommodating beyond belief. After 10 years, we've had this recovery, and normally they would be tightening, and yet the economies of the world are not doing very well. I mean, we hear a lot of propaganda. You'd hear it from the party in power here in the United States. You turn on Fox, you can't stop hearing Sean Hannity and all the rest of them talk about how great the economy is. That's a lot of baloney, I think. I think you would agree with me that that's probably a lot of baloney. It's not nearly as good as what it's cracked up to be, at least. Do you agree with that?
Well, there are a lot of signs under the surface of a slowdown.
Yeah. And
that is spooking the central banks of the world because they understand that a financial system this leveraged might not be able to survive a year of negative growth worldwide and a 20% drop in global equities and the other things that normally come with a recession. So they're trying to preempt what they see is as a possible recession. It's not happening right now. Like, we are not in recession yet, I don't think, but there are signs that we might be headed that way. The most important of which is that we've been growing for 10 years. That has never happened before. This is the longest expansion ever. Right. So it's like looking at the oldest person ever. They might not be sick, but there's a pretty good chance they won't be around much longer just because there are limits to these things. And so the central banks are terrified that we're bumping up against limits that will lead to a recession that could easily metastasize into a depression. These guys don't know how to stop something like that necessarily. Right. So they're trying to stop it before it gets started because it's presumably easier now than it will be a year from now when we're back in a 2008, 2009 scenario where everything's collapsing and nobody knows what's going to happen next. But as with any kind of an addiction, just giving the junkie a bigger shot of the drug, that staves off withdrawal for a little while, but at the cost of a much, much more serious problem down the road. So, it's really not clear what the effects of a massive round of easing from central banks around the world will be if we're already starting at negative interest rates in Japan, negative interest rates in Europe, not that far from zero in the U.S. Where do we go from here and how much further down can we go? Economists used to talk about the zero bound, which was, zero interest rates. We can't go below that because that will distort the financial system in ways that are unpredictable. Well, Europe and Japan did that. And they didn't blow up. So now economists are talking about the effective lower bound. In other words, the number that's negative that we can't go beyond, but we don't know what that number is because we've never tried to go beyond it. So by God, we're going to try to reach that number and see what happens. So that's what happens next time around. We do this immense financial experiment with the entire global economy where we search for the negative interest rate beyond which we can't go. That's,
crazy.
From a safe distance, for a finance and economics nerd like me, this is fascinating. This is the most interesting time to be alive ever. But I think for basically anybody else, this is not going to be fun. When we find that number, And it turns out the central banks have no weapons left. They don't have a thing left to do when negative 2% interest rates don't ignite a boom in the economy. And
John, I'm not so sure it's going to be fun for any of us nerds either. Actually, I think Alistair pointed out that generally, in order to get things to turn around in an economy, once you're in a recession, you need a decline of about 5% or something like that historically. And we're at arguably 2.5% or something like that now, 2%, 2.5%, depending on which market you're looking at. That would imply a negative 2.5% just to get us to where we were before. Who knows? But the other thing I'd like to ask you about, though, is this idea of moral hazard, because it seems to me that stock market players are sitting back and saying, we don't have to worry. Every time the market starts to tank, or as David Stockman says, has a hissy fit, to the rescue comes the Fed. And I can understand that because, as you said, with this leverage in the economy, the equity market starts to spiral out of control on the downside, which Michael's work suggests is more likely than not. Then what are they going to do? And if they're scared to death of this market, the equity market, because people borrow and, it's leveraged to a great extent, and then people have to start selling stuff in order to make good, and all of a sudden their assets are gone. And the fear grips the markets, and you can understand why the central banks are doing what they're doing.
Oh yeah. Well, in one sense, you can understand it because they don't want to be this generation's Herbert Hoover. In other words, the guy who's on top of the system when it blew up and be blamed for it for the next 50 years. We still know who Herbert Hoover is. Yeah. Because he was the guy in charge when the Depression started. Right. And they don't want to be that guy for forever after. Yeah.
Donald Trump, of all people. I mean, he's the greatest, right? So Donald Trump is going to, he doesn't want to be Herbert Hoover.
Of course not. And neither do the guys in charge of the Fed or Treasury or the Senate or any, they don't want to be that guy. So they're doing whatever they have to do to get through the election cycle and the corporate reporting cycle, et cetera, et cetera. Two reasons, though. You said something about the stock market being kind of insouciant right now. Yeah. There are two reasons for that. One is that stocks in the aggregate now yield more than bonds. Yeah. Mm-hmm. So stocks are becoming a safe haven play because they generate more income than treasuries. And so people are less worried about capital gains with stocks. So the stocks don't go up for the next 10 years. If they're yielding 3.5%, that's awesome compared to their fixed income portfolio. Sure. Yeah. So that's one thing. The other thing is that when central banks panic, what panic means in this world is, much lower interest rates, but also direct buying of equities with newly created currency. In other words, they'll run the printing press, they'll use it to buy the S&P 500 and bid up the stocks of major U.S. companies. And the third thing is that if they have to devalue the currency really aggressively, in hyperinflationary economies, stocks usually go way up because, the value of a company doesn't change if the value of the currency plunges. Right. So measured in that currency, the stock price of a given company should go way up, right? Because we're changing the unit of measurement, but nothing else. So stock markets go up in hyperinflation. So for those three reasons, you can justify buying equities right now. I don't necessarily think those are great reasons, but they are rationalizations that you can use in front of your investment committee if you're a portfolio manager or something like that. And plus, where else do you go? That's the fourth reason. There's nothing else to buy.
Well, as measured in German Deutschmarks during the hyperinflation in Germany, stocks did go up. It was better than holding Deutschmarks, but still, if the Deutschmark is worthless, what does it really mean? So it's. I guess you want to hold something that's real. That's why it's just, a currency of value with intrinsic value like silver or gold.
Yeah, see, that's the ultimate investment thesis in all this, is that you own real stuff that governments can't make more of when governments are destroying their currency, which ours are pretty much across the board in the developed world. So that means gold, silver, farmland, et cetera, et cetera. Your listeners are very familiar with that thesis and might be kind of frustrated with it because it's so simple. But you know what? Sometimes the simplest answer is the best one. And in this case, I think a big stack of silver coins or a smaller stack of gold coins, is probably the single best thing you can do. You can make a case for selective shorting of a lot of stocks, but for reasons that we've already covered, that's very dangerous. Although it could be incredibly profitable if past history is any guide. But that's not a store of value. That's a speculation that might really pay off. So it's a separate category for your finances. But if you're trying to protect purchasing power, you need to get into things that cannot be created in infinite quantities on an electronic printing press by some crazy government. And that's a limited selection of stuff with gold and silver at the top of the pile right now.
Well, John, what's your hunch in terms of U.S. dollar going negative rates? Because you're suggesting that perhaps we're at a blow-off phase now, that the rates are going to start to climb, possibly. But the other argument is that we're seeing. I'm looking at a chart here that shows all of these countries in Europe, and including as well as Japan, in negative territory. In fact, there's about 4 countries all across their treasury yield curves they're negative, including Germany, Netherlands. I think there's several of them. Finland, and so what I saw that there's something like 94% of all investment grade bonds in the world are denominated in U.S. dollars. So all these people are looking for positive yield. They're going, as you pointed out, the stock market is another place to go, and one reason why stocks could keep climbing, one of the reasons they're attractive. But it's also a reason that's pushing interest rates down in the U.S., arguably, right? So if foreign governments continue to print more and more money, the economies aren't really going too fast. They're not growing very much at all because there's so much of a debt overhang. The debt is eating up all of the wealth, essentially. So what's your hunch? What do you think the prospects are? Alan Greenspan says it's inevitable. We're heading towards negative rates, I suppose in part for that reason. But what do you think?
Well, I think we're going to try. But, as we talked about before, there's that effective lower bound thing that we have to discover. And we'll push interest rates down because we have no choice now. If the economy is slowing down, or if the stock market gets volatile, which it will do if we stop cutting interest rates, we have to continue to cut interest rates for that reason. And we'll keep doing it until we can't anymore. In other words, till the system blows up. But whether it's negative rates or something close to zero remains to be seen for us, because the dollar is the world's reserve currency. So the rules are somewhat different. And your interview with Alistair McLeod, I would steer everybody to that, because he gives a really good explanation of the mechanism that might stop this thing in its tracks at some point.
Go ahead, John.
Okay, well, I was just going to say, so we know that secondary currencies like the yen and the euro can see negative rates without instantly blowing up their financial systems, but we don't know whether the same rules apply to the global reserve currency. And apparently we're going to find out. I mean, this is the kind of thing where, like finding out how fast your car can go around a steep turn or something like that. Yeah, maybe it might be interesting under some circumstances to know that, but you really shouldn't find out unless you absolutely have to. And that's what we're doing now with the dollar.
That's a good analogy.
Yeah.
They don't know because unlike somebody who's completely rational and sane, they don't want to test it. The central banks, I guess, don't have any choice, or they feel they don't. They don't know what else to do, because what they should have done, of course, is just stay the heck out of the markets for years and years ago. We know that as free market people, don't we, John?
Well, yeah. I mean, if we could rewind time and go back to 1971, there's a fairly straightforward fix for this, is we just stay on the gold standard, or the remnants of the gold standard, and limit the ability of governments to manipulate currencies and to manipulate their domestic economies. And we would be so much healthier now than we are. But we didn't do that. See, we already made the mistakes that are going to destroy this global financial system. So the only thing that's left is exactly how are we going to do it from here? In the last few years that we have left in this grand experiment with money that doesn't mean anything, how will we blow it up? And that's what's, we're having fun talking about it, but we can't really know the details of it, and we can't really know the timing. But it's pretty clear now with what's going on in, there are negative yielding junk bonds in Europe, and the U.S. the U.S. government sector is almost the only sovereign debt sector in the world with positive yields. Almost all the other major bonds out there are yielding negative rates now, and that we got to be pretty close to the end, right? How much further can we go? But that's the big question, really, is the timing of this, and it's possible we can go somewhat further, but not too much, I don't think.
Well, the point is we're addicted. As you drew the analogy earlier, we're addicted, and the only way that we can, it's an addiction, and it of course, it also has, going off the gold standard has allowed the redistribution of wealth to the people that are closer to the creation of that wealth, namely the military industrial complex, the government, and the investment banks, and those and the central banks and their cousins, their children, that are the commercial banks, the big money center banks, and all those people making tons of money. In fact, Alistair was talking a little bit about the dynamics that's driven this gold price higher. And that had to do with the unwinding of the gold carry trade, in fact, so that the bullion banks, as long as U.S. Treasuries were selling at nice positive yields, they could borrow at the gold's interest rate, the lease rate of about 1.5%, 2%, sell the gold, use the dollars to buy Treasuries at 4%, let's say, or 5%, and then leverage up on it and make tons of money. So this sort of thing allowed the redistribution of wealth, I would argue. Booming stock markets, lower rates tend to seem to help the people that are rich and hurt the people that actually work for a living and do things and make things for people. So it's a sad commentary on Lord Keynes, I suppose, what he's created. John, with just a couple of minutes left, I'd like to get your ideas on, Mark Carney comes out and suggests that the dollar's days are probably numbered. He's calling for a global monetary system to replace the dollar, he said at Jackson Hole. It is, so The Economist in 1988 put out a special article, a special issue, suggesting that by 2018, we would be looking for a new currency regime of some sorts. And then I look at history, and I see that through history, the major powers, starting with Portugal back in the 1400s, the time of having the world's reserve currency has been fairly limited, and our time is almost as much as a number of those institutions, with those countries, I should say. Real quickly, what are your thoughts about the dollar's future and what that might mean?
Well, I think none of the fiat currencies are going to survive in their current forms just because they're so obviously being inflated away and just grossly mismanaged in general. The shape of the monetary reset when it comes is, of course, unpredictable. We could just announce on some Sunday night that henceforth the dollar is just a name for a certain weight of gold. And
not likely.
Gold, yeah, that would be the simplest way, but that would mean giving up immense amounts of power. So Jim Rickards says we'll go to the IMF, make them the world's central bank, and then use special drawing rights. But those things are just a currency based on a basket of existing currencies. Yeah. So I'm not sure how you derive value from that.
All right, we'll have to leave that for another discussion sometime, John. And when you come up with the answer, we'll have you on for sure. We do have to go now. Our time is up, unfortunately. Too bad, John, because there's so much more to talk to you about.